everybody. Welcome back for another episode. Thanks for joining me. Today, I'm talking about closely held business transition across generations and some of the planning strategies that can be put into place. Particularly here, as we have a window of certainty in the tax code and the estate tax code here for 2024 and 2025. So what we're thinking about are companies that are significantly valuable, that are intended to be operated and transitioned from one generation to another, and perhaps across multiple generations. So when we're thinking about these types of companies, I say significantly valuable, meaning they're going to exceed the estate tax exemption amount. So currently the exemption amount, as I record this in early 2024, is going to be about $27 million for a married couple, meaning you each have $13.5 million and some change to be able to use up that you can utilize through gifting during your lifetime or transfers at your death. And then that is what is exempted from gift or estate tax, which at the federal level is currently set at a 40% tax rate. So meaning that if you have a $50 million company that's going to be transferred, $27 million of that is going to be able to be passed down without any estate tax, but the next $23 million is going to be subject to that estate tax. And so in this particular case, that generates an estate tax bill at the federal level of about 40%. And then there are 13 different states that have a variety of estate or inheritance taxes that are subject as well. So just really focusing on the federal level and that exemption amount. Now, you can handle that $10 million of estate tax through different insurance strategies, particularly something called an Irrevocable Life Insurance Trust, or ILIT, that allows you to create a vehicle where you gift premium payments to the ILIT. The ILIT purchases and maintains a life insurance policy on the value of your life, and then at your death, receives the death benefit and passes it down to beneficiaries with the purpose to be able to pay that federal estate tax. Now, we tend to see this done much less frequently than when the estate tax exemption amount was much lower in the past, but it is still a really important tool that's available to families. And the trick there is that death benefit is paid outside of your estate. So even though it's going to perhaps the same beneficiaries of your estate, because it's flowing through that trust vehicle, it is not considered part of your estate. So it doesn't make the problem worse and add to the value of your estate and increasing your estate tax burden further. It's just designed to be able to receive premium payments, maintain the insurance policy, receive the death benefit, and then be available to your estate to pay that estate tax bill. That's probably the most straightforward example. When we look at some other more complex ones, we can get into a lot of four-letter different types of trusts that are out there. And one that I want to touch on is called a GRAT, a Grantor Retained Annuity Trust. So in this, it's a tool where you can transfer equity units or the business property that you currently have inside the trust and then elect to receive an annuity payment, meaning income, for a specified period of time. So let's just keep our example very simple. You contribute your $50 million of business to it. You elect to receive $1 million of income each year for the next 10 years. You would be able to discount the value of the business by the value of the annuity income stream. So in this case, about $10 million. The devil's always in the details. So please, please, please don't do any of this without consulting your attorney, your CPA, your wealth advisory team, people who actually know how to set these up so that they meet all the rules and requirements to do what you're trying to get them to do. The value of doing something like a GRAT today is that you're able to utilize the existing estate tax exclusion amount as you contribute the business to that annuity and sort of lock those amounts in. So lots of benefits there, lots of reasons that you might want to look at one here in the next couple of years. And hopefully this gives you something to think about before we head into expiration of the Tax Cuts and Jobs Act at the end of 2025. I have some other episodes where I've talked very specifically about provisions that are set to expire and some things to look for there. But transfer intra-family of business interests is going to be a big one and a big area to think through your planning here in the next couple of years. So hope this was helpful, and thank you so much for giving me some of your time. We'll be back again soon.